Australia's unemployment rate has remained steady at 3.5% in March. That's near 50-year lows after the economy added a bumper 53,000 jobs during the month. The total number of people employed in Australia has surged to a fresh high of 13.88 million. The participation rate, that's the number of people either in work or looking for work, remains steady at 66.7% after it was revised up from the previous month. The underemployment rate increased to 6.2% and hours worked fell by about 3 million hours during the month. Joining me now is KPMG Chief Economist Brendan Rynne. Brendan, thanks so much for your time today. Job market still looks really strong in Australia at the moment.
Absolutely. I mean, you can't help but just interpret these numbers showing that the economy must be powering along and the job market is powering along with it as well. I mean, the 53,000 new jobs for the month, when if you had a look at the ABS payroll data, you would have anticipated something more like 20,000 new jobs. So it really outperformed all our expectations.
Plenty of job vacancies still out there as well. When are you expecting the unemployment rate to start ticking up in Australia?
So we think that this year, economically speaking, is going to be a tale of two halves. So the first half of this year is still, there's elements of strength in it. But in the second half of this year, we expect with interest rates increasing and the bite coming through consumer spending about to commence, we think that the second half of this year is going to be considerably weaker. And with that, you should start to see the unemployment rate start to tick up.
Participation rate at the moment, 66.7%, near record highs. How tough is it right now for employers to find workers to fill all these job vacancies?
Oh, look, it's incredibly tough. I mean, we know in our own business it's really hard to find the right skilled labour that we need to continue to provide the services at KPMG that we do to our clients. And we're just one of many employers out there that are having that same experience. The fact that we've reopened our borders, we've had incredibly strong net overseas migration coming through, and we saw that, although the data's a little bit old now, the September quarter was the highest on record. And we see that people are coming back very strongly to try to fill jobs that we're screaming out for workers to fill.
Looking across the states, the number of employed people in New South Wales and ACT decreased by about 0.5% during the month, but it looks like it rose everywhere else. What's the sort of differences there between the states?
So it could just be a number of factors, including just a settling of employment and catch-up employment that occurred. We knew that in February of this year that there was also a strong rebound in employment. There was about 65,000 new jobs filled in February. Some of that was churn with regards to employment of people leaving jobs in December and starting new jobs in January and February after taking a bit of a holiday. So there could just be some overhang associated with that very strong employment for the first 2 months of this year.
How's the Reserve Bank going to interpret these figures? Do the numbers today basically lock in another interest rate rise next month?
Well, it's hard to say that they're going to be locked in, but we were certainly of the camp last month that rates should have risen. We know that Dr. Lowe had indicated that there are 4 key pieces of information that they look at in terms of whether to adjust rates or keep them stable. One of those pieces of information is employment. You'd have to think that at 53,000 new jobs for the month that would put upwards pressure on the RBA looking to raise rates another 25 basis points next month.
And what do you predict will be the peak for the cash rate in Australia? Is it 3.85% or is it a bit higher than that?
It is a bit difficult to say, but I think that it is probably one more rate rise left in us. We certainly think that monetary policy is operating on a two-stage basis at the moment. Not only is there the normal lags that occur in terms of when rates go up to when they start influencing aggregate demand, but the other factor that's really influencing spending patterns at the moment is the fact that there's still a large proportion of mortgages that are on fixed rate terms that are about to roll off. And those households really have been sheltered from the interest rate increases so far, notwithstanding the fact that many of these households are probably starting to adjust their spending patterns in advance of getting those interest rate shocks coming through. But for many of those households, they're going to experience at least a 3% increase in the rate that they're paying on their mortgages, which will filter through to spending pattern changes over the next 12 months.
The IMF, it's warned Australia's economic growth is going to creep ahead, just 1.6% this year and about the same next year. How close to a technical recession are we in Australia?
Look, I know that those IMF numbers look pretty weak, but in fact, our own forecasts suggest even slightly weaker numbers. The challenge with a technical recession, and for all intents and purposes, it's really only us economists and you in the media that really worry about defining something as a technical recession. I think that we'll run close to the wind in terms of getting 2 quarters of negative growth. We might find that there will be 1 quarter of negative growth and 1 following quarter of anemic growth. But for the average punter out on the streets, they're going to see, particularly in the second half of this year and first half of next year, a much, much slower economy. And so while we worry about whether it's technically in recession, most Australians are going to feel like we're in a recession.
Well, KPMG Chief Economist Brendan Rynne, thanks so much for your time today.
Thanks very much for having me.